All right, hey, welcome everyone. Welcome to the Hurley Investments Market View Commentary for the 19th of January. We're off on a new year. Please hit myhurleyinvestment.com to catch last week's if you missed it. Tonight we're going to run a trade findings and adjustments at the very end that I will spend more time going with you through with you on Thursday morning. Our 10 o'clock typical trade findings and adjustments. For those that are here, please welcome James. James is a new individual that's here with us today. James, there are about 15, 16 of us now. And it looks like a couple of your friends are here, so I'm sure they're going to, there you go. I got a couple that say, welcome, James. Good to have you, James. A couple of people are welcoming you to the group. Nice to have you with us. To start out for today, our market pulse for last week. S&P fell 1.5%, basically flat for the year. They have for the year, it's a gain of 0.3%. You know, it's flat. It's not moving. Largest percentage sectors of the drop last week were communication services. Technology was down 2.6%. Consumer staples, consumer discretionary materials, 1%. The reality is we're getting a footing before earnings. All we're doing is getting a footing of the market before earnings. Usually you have a bit of a drop after the Santa Claus rally, which starts sometime the middle of December. There's not an exact week, but they usually end it at, the 5th. January 5th is usually considered the end of the Santa Claus rally. Not much to speak of. We're still worried about vaccines getting out and COVID. Expect a huge increase in COVID cases about the middle of March into April. Do not think it's going to follow last year's timetable. It will not. It is going to be a little bit different, but we will have a timetable that will be different than last year as we see some type of increase in the spreading of this of the flu. It's worse than the flu, but the short answer is, if we saw what we happened last year, and right now cases and contagion is about 4 times as bad with the same death rate, if a little bit less, expect our market to act likewise. And the biggest fear, anyone know, what's the biggest fear with COVID cases spiking? Someone take a guess. Someone type in, what is the biggest fear of COVID cases spiking? Anyone? If you don't know, type a question mark or 2 in there. Hospitals unable to treat it. There you go. One of the fears is that there are not enough spaces in the hospital to treat it. The bigger fear I'm going to give to Russ. Absolutely correct. Even a bigger fear is shutdowns. Rich Mormon, shutdowns. Williams, shutdowns. You're going through it over there in United Kingdom right now. Shutdowns. If they shut down the economy, we're in trouble. We're in trouble, and it's going to be, again, most likely a 4-week like they did in the UK to try to eradicate the virus. Man, I just feel like we're heading down that road. I really hope that I'm wrong, but dang it, it's my expectation. This week we're coming into the second full week of earnings. Those earnings are typically going to be the banks. We have 1, 2, and 3 weeks of bank earnings. With that said, Alcoa reports this week. Alcoa, which is traditionally the start of earnings seasons, ticker symbol A as an apple, will be on Wednesday. So earnings season technically starts on Wednesday. For us in our core holdings, we had Bank of America open before the market opened today. Beat on the top line, missed on the bottom line. Revenues came in light, and I'm going to show you a little something on that here just in a bit. But plain and simple, it was a little bit rough. Little bit rough on the banks, which if they're making some of their money trading, you kind of scratch your head, right? Earnings season technically starts on Wednesday. So we're going to start having earnings move our markets. With that said, Dow Jones Industrial Average right now, currently bullish. Where will our markets end this week? I'm still going to go with down. I'm sorry, someone just typed in, where will our markets end this week? I'm sticking with down. I don't see earnings because retail sales and our GDP numbers were nothing to really speak of. I'm not sure I see earnings taking off. We are bullish. We are moving higher, kind of flattening out before the earnings. Usually you get a bit of a dip. So the fact that we had a day that we had a spike, news-driven spike, right? Usually we get a dip and we'd be testing the 50-day, if not down around 2750, giving up a little bit from the year as people take their tax sell-off here the 1st of January. S&P 500, same thing, almost a mirror image. Still bullish, still moving higher. Same thing as we're looking at the NASDAQ. We're almost overbought, right? We're almost going to see this head on up, especially with Netflix knocking it out of the park. Let's see if Netflix still held its aftermarket gains of over $50. Netflix. After hours, it's up $61.43. So expect Netflix to run our futures tomorrow. If we were to take a quick peek at futures tomorrow, come on. Go to CNBC. Futures pre-market. Wow, NASDAQ's up big, right? NASDAQ is up big, up 0.44, a half a percent, 57.75 points. And that really does come down to Tesla. Tesla's off to the races to move the markets higher, at least looking that way for tomorrow. All righty. With that said, let me run to answer a question. Did I really shut that down? I did. So I was asked, hey, would you go over this KL allocation fund? Someone's in the A shares. Oh, it's got this great performance. You know, we're so good, blah, 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 blah. And basically it was a lesson again on averages. I know this group has been in here for a little bit and I preach understanding averages, right? So let's talk averages one more time here, just to help you guys better understand averages. Last year, a lot of people didn't make any money in the stock market. Yet their average return was, oh, the S&P's up 15%. The problem is when we came down and we hit 28.86, When the stock market lost 28.86% of its return, we only had roughly 71 cents to make it back. And when you multiply that 71 cents by the gain which we had, which was, 43 is actually 44, right? If I was to take 71 cents and multiply it by itself plus a 43% gain, we come out to only a 1.0153%. 1.5% gain. Now we were only down 28.86, so it actually comes out to closer to about a 2.7% return. A lot of people that I knew were down between 5 and 6%. That because they were in an asset allocation model, or that would be a 60-40 asset allocation model, or they're only up 2% last year. And they're worried. They're like, man, I think this year's going to be even worse. And to be honest with you, I also think this year is going to be even worse. But someone basically said, well, Kevin, help me understand this. Help me understand this. I want to make sure I understand what's going on here. This GAVIX fund, or GAVAX, it depends if you go in Class A share or not. You get their nice little spiff sheet. Hey, it only costs between 1.29 and 1.54. Excuse me, 4. It ranks in the first percentile for alpha. It beats the average world allocation fund, which is 5.2%. It's doing so much better because it's at 15.74. It's amazing. Out of 481 different different positions. And you're thinking, man, this one is a blowout. Got to get into it, right? It's so cheap. And then you start reading the fine print. Where's my fine print? You need to read the prospectus or summary, because for this announcement, the advisor contractually agreed to waive its fees and or pay for the operating expenses. Don't forget there's an interest expense, brokerage commissions, dividend, and other interest expenses on short sales, acquired fund fees, reorganization, extraordinary expenses, litigation expenses. And the comment is, oh, but we don't expect them to exceed another 1.5 to 1.25. So basically, there's more expenses on top of this that, that kind of double the cost basis. There may be fee waivers where they waive it for a little bit of while, right? Hey, I'm going to waive the fees while you take this picture. It's funny because I went through it and, since inception, a 7.78% versus a 7.75. It looks like it beats it. But can someone tell me what is not taken out of their 7.75% return? What is not taken out of there? Where when you look at a 7.75% return for the S&P, everything's kind of in it. What's not taken out of that 7.78% return? Exactly. Fees, right? More fees. That's what the positions went into. And it scared me because most funds will drop their losers that last quarter, put some winners in, and they get to count those. So I just found it interesting. I mean, it's a bunch of garbage, to be honest with you. Blah, 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 blah. You read through it. Oh, it looks so pretty. Look at these graphs and how it's done in a 5% drawdown periods. I mean, it's the blue and you see some of these reds. It just talks about being this amazing fund. Notice how it doesn't show in there 2008, right? It looks pretty. I mean, in all honesty, it's a shiny coin placed in front of you. Here's everything that we're in, blah, 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 for right now, right? And then you start reading max drawdowns, and you're just like, oh my gosh, I'm not going to read this page because it's awful. But this is your slick that tells you that you should be into it. The biggest uh-oh is that it's a mutual fund. And it's open-ended, no less. And as soon as you see an open-ended mutual fund, you know there's a problem. Someone just typed in, sounds like REITs and annuities, and the fine print didn't mention training and seminar costs and all the other costs that go into it. Kevin, you said funds usually have triple the amount of fees. This is their slick. What's really in it is this ugly thing right here. This is the summary prospectus. This is the real understanding. But again, you have to translate it. It's a kind of amazing. Fees and expenses, right? Which when you look at the objective, long-term capital appreciation and capital preservation, that's what you're trying to do, right? Be prepared to be shocked. Here's your table. You're going to pay 1.5%. Something to understand, though. The total annual fund operating expenses and net operating expenses do not correlate to the ratio of expenses to average net assets. In fact, this reflects only the operating assets of the fund, does not include acquired fund fees and expenses. So here's the total operating expenses, except for the crap we didn't tell you. Way to go, Dodd-Frank. You're doing a good example. Some percentages. Oh, this is a huge shocker, right? I couldn't believe it. Going to go to a pen. The fund pays transaction costs, such as commissions. Anyone know what the commission is for someone like me? Round number. Give me a round idea. Wow, you guys were quick on the trigger finger there. 0%. In your dreams, right? Wait, there we go. Here's some other ones. 1.5%, 1%, correct. Usually for someone like me, I'll get a commission of 1%, but they also will give 1% to the brokerage house. So one of the transaction costs is a 2% commission fee. Another comment, which I found just absolutely ridiculous. Portfolio turnover may indicate higher transaction costs. Usually transaction costs are between 18 to 20% turnover in the portfolio. That will cost 0.4%. Legal underwriting. If you roll over this portfolio, let's even give it a break. Let's go to 25%. If you churn the portfolio 25%, you will have transaction costs plus taxes in this account. The turnover rate was 215%. They're charging at least 3.2% for transaction churn or turnover, or moving the losers out and putting some winners in. The worst part about it, it may result in higher taxes. This is a fund. A fund has an EIN number. An EIN number is a taxable business number. If the turnover rate's 215%, you're not getting taxed at long-term capital gains rate. You're getting taxed on a fund with multi-millions of dollars at a corporate tax rate, which is 21%. 21% equals to roughly somewhere between 2.1 to maybe on the high side 2.7% of the value of the fund when it's all said and done. If we take the taxes on the low side at 2.1, we take the commissions at just a minimum 1% just for me, not even a brokerage house. If we add their 1.54, we're talking about 5.3, 6.3. We're talking about 7.84 with all these added together. 7.84%. Someone just asked me, do you make money on it? If since inception, your average return is 7.78, or for the last 10 years, it's 7.52, and your fees are 7.84, do you think you made any money? Hey, last year or year to date, last year we're up 13.68%, which is almost double the average. So how many years did you have losers that you paid extra fees for? You just got to think about it here. And I'm going on the low side. I don't know any brokerage firms that are like, oh, pay my rep, but don't pay us as a firm. It gets even worse. We have fixed income. We're putting you into 60% or 40% fixed income. So let me walk through that with you really quickly. Kevin, what is a 60-40? These beautiful retirement target dated. The reality is they're putting you into 40% of your portfolios into bonds of some kind. Most of them are 10 years, could be a 7-year, could be a 30-year. So you've got somewhere between 0.27 upwards to as high as 1.78% high-end return on the fund. But remember, that's only 40% of the portfolio. So 40% of the portfolio, what I'm going to do is I'm going to take 1.78 and multiply it by 0.4. You're only going to see a net gain on this side of 0.712%. So you make 0.7%, assuming you're in the high side of those U.S. Treasuries at 1.78%. So if you had the other 60% of your portfolio in something that made 20, let's go even easier, that made 25% return, right? You only get to count 60 of it because it's only 60% of the portfolio. 25 times 0.6. 0.6 divided by 25. 25 divided by times 0.6 is 15. A 15% return. You add that onto this up here, you're looking at, a 15.71% return. If we take this to the 14 that it was last year, 14 times 0.6, it's only an 8.4. Added on with the 0.7, you made 9.1% and paid 7.84% out in fees. You want to talk about risks? Market risk, equity risk, fixed income securities risk, foreign investment risk. All of a sudden, when you're in a foreign investment, that country usually keeps the 10% for their taxes that you pay over there. Add another 1% on to the fees here. ETF risk, I guess they're just taking about every dang risk possible. Derivatives risks, portfolio turnover risks. A high rate of portfolio turnover is what? What is the risk? A high rate at 100%? Anyone remember what their portfolio risk rate was? Hey, a high risk is 100%. That's high risk. Watch out for it. Oh, but don't worry. Don't worry. Because our turnover rate, where was it? Oh, I had it on, I'm sorry. Was it here? Where did I find it? I showed you it was a 200%. Oh, I'm sorry. This is back on here. Hey, a high turnover rate is 100%. Be careful of it, right? 100% or more. Oh, that's risky. Got to watch out for it. But, our turnover rate was 215. In their own risks, it tells you. Oh, it's super high risk. If you have over 100% turnover rate, that's way risky. And they're twice as bad as that. Can I ask you guys a question? How many of you would like me to put you in the #1 Morningstar ranked allocation fund out of 481 global equity type funds? A world allocation, a global allocation type fund. How many of you would like me to put you into that? No one? No one's just, wow. Let me answer. Let me just state the 3 answers that came in here. Not in this lifetime. Kevin, I would kill you. What a crock of a crock of something. Great three answers there. Not in this lifetime. Kevin, I would kill you. What a crock of something. Beep, beep. So, all I'm trying to show you here tonight, thank you for that special someone that let me go through this tonight. Just because it looks pretty on a slick. And this is the one that is based in the 1 percentile rank by Morningstar. Do you think the market's not rigged against you? You got a 1 out of 3 chance of making money if it goes up. If it goes sideways or down, you get your butt handed to you. And not only that, with the fees that are involved in funds, it's more like you have a 1 out of 5 or a 20% chance to make money in the stock market and an 80% chance of losing money. There are a couple of you here today that I know have been in the stock market for 10 years and haven't made anything. I've told most of you my story about Vanguard. Plain and simple, averages are not your friend. Funds are not your friend. You've got to do something different in the new normal. So I hope you appreciate what Hurley Investments is trying to do with your money. I'm still thinking we're going to be flat in January. I haven't moved off of our growth. Earnings will come in and earnings will be good and some will disappoint. We're back to a stock picker's market. Earnings for this week, Bank of America this morning, Goldman Sachs, Halliburton, Netflix, Zions Bank. Tomorrow, Alcoa starts out. Kinder Morgan is there. United Airlines, U.S. Bank Corp, Morgan Stanley, Fastenal. Thursday, UNP, CSX, IBM, Intel, Intuitive Surgical. One I'm going to pay attention to, but I'm not investing in yet, is going to be Carnival Cruise Lines and KeyBank. Friday, Schlumberger, First Horizon National, Bloomingdale's. Economic report's pretty quiet across the board. Should be a pretty quiet week. Don't look to see a lot of economic reports moving anything. Wednesday, we have China has their FOMC or interest rate meeting. And then on Thursday, I'm pretty sure it's the ECB, right? Thursday, it's, yeah, the Euro, ECB. So Thursday, we have the ECB interest rate decision. It's much like our the Federal Open Market Committee. That's what these are, and that's what's happening this week. How am I looking to trade? I'm going to jump into here in just a minute, but pretty interesting. I found an article that basically said, hey, more advisors are charging separate financial planning fees. Here's why. Well, why do you think they're trying to charge separate financial planning fees? Understanding a financial plan never has worked in anyone's lifetime because they give you an average or a linear growth on your money. And obviously the market's never moved in a linear fashion. I can pull this up one more time, and I think it's kind of funny that here's your stock market, right? Please tell me what linear growth rate you see there. When in real life, if you ask me, 1,500 and 2,000, to double it, I see that being 2020. 20 years to make one doubling on the S&P 500. And that's not counting the crap they took out of there every year as bad companies get shuttled out, better ones get put in here. Oh my gosh, is all I'm going to say, right? Oh my gosh, someone please help us. No one answered. No, there we go. Because they want to charge us more money. Exactly. They're looking at flat fees, charging you $2,500 for a financial plan that mathematically can never work. Commissioner asset-based fee, financial planning is shot up from 8% to 72% last year. Advisors are being warned about churning people in and out of funds. So they're trying to come up with a different way to charge you more. Instead of wrapping it, you can make more money by separating it out of a wrap fee, calling it something different than assets under management or financial advice. It's just a plan. What a joke. What a joke. It makes me more competitive to print you out 60 pages of garbage and charge you $2,500 for a financial plan that'll never work. All right, let me get off of this one because you guys can hopefully tell it bothers me, right? JP Morgan and wealth management assets up 70% year over year, but yet income is down. So someone please tell me, what does that title mean in plain English? JP Morgan assets and wealth management assets up 17%, but net income is down. I'm going to keep that comment to myself. Lower their revenue on assets. So yes, I mean, that's one way. William, we talked about it, so go ahead and type in your answer if you want to. What does it mean? JP Morgan asset and wealth management assets up 7% year over year, but net income down. Oh, you guys are going to hate the stock market. You're going to hate wealth managers by the time I'm done with this, right? Let's let the numbers do the talking yet again. Assets stood at 2.72 trillion, up from 2.56. But they had inflows of $190 billion. So if I do my math, you add what it was from last year plus inflows. You know, I'm going to see that this says, if I add those two numbers together, this is telling me that their net assets should be 2.74, which means if their current assets are only 2.72, will someone please tell me what happened to JP Morgan last year? What happened last year? Bingo. They lost we're talking billions, right? They lost $20 billion. Just add the inflows in, 2.5 trillion, add, the 0.19 there. These sons of a guns lost $20 billion last year. Those assets under management took a hit. They're basically flat, but they took a hit in a 14.44%. And someone asked me again, Kevin, how is that possible? Can you please explain to me how that is possible? It's easy. We had a loss of a 28.86% last year. That was the downside. Can someone please tell me, type in, if you are a low risk individual, please tell me, what is your maximum loss that you can take if you are a low risk individual? Give it to me as a percentage. How much of your percentage of your assets under management can you lose if you're a low risk individual? William says 0. Mary, you say 5%. That seems high, but okay. Anyone else? How much can you lose if you're a low risk individual? 4. 1 under. Russ says 5%. David says 3%. So I've got 5 answers out of 27 of you here. 5 answers that say, it's 5% or less. But Mr. Bosserman just came in with the correct answer. I can lose up to 25% of your portfolio at a low risk level of risk. And what's what I'm trying to say though? If you have a low risk tolerance, a low level risk tolerance, that means I'm not in trouble until you lose 25%. So if you noticed as the market was falling down, a lot of people say, Kevin, I don't really understand why markets have this deep downturn in them. I don't get why it seems like we hit a certain amount of levels and the bottom just falls out. The bottom falls out, and before you know it, we go through a ridiculously huge, let's go out to 2 years. Here we go. We go out to a huge weekly drop where the bottom literally, the bottom falls out. The bottom falls out. There's certain levels that you hit that when you start to approach that 25%, 18, 17, 20, well, crap, I got to shuttle all of my low risk individuals into a U.S. Treasury bond fund that guarantees them somewhere between 0.2 to maybe a 1.78% return. And so you see these big swishes down because all you're seeing in real life is money managers like myself protecting themselves from putting a low risk individual into a loss of over 25%, which means by law that broker was not doing his fiduciary responsibility. Medium risk is losing up to 50%. High risk, you could lose up to 75% of your portfolio before someone like me ever gets in trouble, before a licensed bond and insured person could run into an issue, could have the SEC asking if we're doing what's in your best interest, being criminally responsible for those losses. So what do? The funds I put you into, if I'm a fund guy, I'm going to put you into these funds. I got to get you out of them really quickly. Because of your risk tolerance, I got to put you in something that guarantees me a small return so your account doesn't hit a 25% loss. So when I go through quarterly SEC audits or company audits or brokerage audits, that I'm still maintaining my fiduciary responsibility. What a joke. But now you understand what that risk is and how an industry professional looks at that risk compared to how you look at your risk. You guys are only off by like 20 to 25%. And I think the reason why Jim Bosserman knew the answer is because we talked about it yesterday. All right, what else do I have for you? Biden poised to pick Wall Street critic Gary Gensler to lead the SEC. More garbage I'm going to put up with, but you guys should at least know who's going to be in charge of me. Companies are preparing to cut jobs to automate if Biden gets $15 minimum wage hike, reporting shows. A very interesting article, what a rise in minimum wage will do to the job and businesses here in the United States. All the numbers are correct. Jamie Dimon says JP Morgan Chase should absolutely be scared bleepless about fintech threat. You want to see about where PayPal, Square, Stripe, Apple, Amazon, all the credit cards are now moving to? Venmo, JP Morgan, Jamie Dimon talking about that risk to their business. And last but not least, a Goldman Sachs S&P estimate. And just to put this into perspective, most people think GDP is going to grow 4.2% on average. They think we're going to have 6% GDP growth. They're outside of one standard deviation, probably two, which just means, as I showed you a couple weeks ago, in all reality, how would I say it? In all reality, someone's forecast is just as much garbage as someone else's, mine included. It's just our best guess. I was going to go through a couple new trades. I'm going to wait till Thursday for that. Any questions? Any questions you guys have that I can answer for you? Rich, this means you probably want to give me a call tomorrow so I can go through those individual trades with you. And William, I will take the time tonight, since you're up, to go through a trade I might be looking at tomorrow morning. But any questions I can answer for you guys on anything I went over or anything in general? William, great question. So what is your bull, thank you, prediction for next year? Well, I'm assuming you're talking about this year that we're already in, 2021, and I'm really worried about the first quarter into April. The first 100 days, we'll probably see a huge amount of executive orders from the president that don't need, and not that it's a war anyway, but that don't need the House and the Senate to vote to approve them. He's going to roll back a lot of what Trump put in place, which scares me, not necessarily going to the Paris Accord, but opening up our borders again, cutting the money for the wall and for border security. My biggest fear is that he's going to take a run on like United Kingdom and shut down our economy again. So that's where I'm going to get ready for another big drop. 28%, I'd probably plan on something between 28 to 40, maybe 35 would be the range. It's just a guess on numbers. But we're going to be ready for the drop by protecting through these earnings season like we normally do. Next question, as we head into correction, crossover, mention your strategy protection. Plain and simple, we add that long put. We add that insurance at a certain price. As your stock breaks through support levels, we'll continue to add a level of protection. Let's use something that we're doing. So I'm going to use Baidu because Baidu is coming up and it's had a heck of a run. As I look at Baidu, we've got protection on Baidu at 250. Rolled it once or twice, but if Baidu has bad earnings and it breaks that 240 level overnight, we might add a second level of protection at 240. So I'll add another long put. And if it breaks 220, I definitely add more protection there. If it breaks 200, the drop on the way down is 140. I could possibly add as many as 4 sets of protection to make up $3 for every dollar on the way down that your stock loses. But I'm going to treat this, since we've already seen it once last year, I'm going to treat it as I would a 2008 year, where the bottom just falls out. where plain and simple, there's never enough stimulus to make up for corporate earnings. And so we're going to just keep stacking up this protection to make more on the way down than your stock could lose. Hopefully that answers your question there. Abraham, in a binary, would you bet on pot stocks? Would you be a Jim Cramer? Canopy, the way to play marijuana. I don't know. But Abraham, I can tell you that Evergreen, and out of the 10 pot licenses that were issued here in the state of Utah, there were only 2 or 3 that were licensed the grow side of it and the extraction of the oils and CBD oils and so forth. It's kind of funny because you can make money on everything. I don't know how comfortable I would feel. I don't know how comfortable I would feel making money on those type of stocks, or how to judge them, or the past history to read charts. I think it's going to be based on a lot of regulation, which is a big pop. But that then puts it into the category of a biopharma, where news and tests results on their first phase and second phase and third phase make all the difference. So plain and simple, comment was made, if you don't make money on it, you can smoke it. I'm not a big fan of them. I think it's more of a regional thing that you need to pay attention with and see where you can get in on a regional level to see what's moving in that area and do some fundamentals on it. But Hurley Investments will most likely not be betting on pot stocks anytime in the near future. All right, any other questions? If not, guys, I want to wish you a good evening. I appreciate you being here. I hope this was helpful. James, welcome to joining us on Monday nights to get an idea of what we go over, how we try to help you be prepared for what's coming up in the week. You've got a couple friends that are religious on trying to show up on Mondays. And again, if you ever miss it, you can always go to www.myhurleyinvestmentsingular.com. And if you pop that up, I've got years worth of these in a backlog. Guys, have a wonderful evening. Pleasure being with you tonight. Look forward to seeing you Thursday morning, 10 o'clock for those that are into trading. Couple interesting trades on General Motors and GE. There's some leap bull calls to give us some time. Look forward to talking to you. William, I'll call you back. And Rich, feel free to give me a buzz tomorrow morning. Good night, everyone. Have a good evening, and thank you for showing up tonight. Bye-bye.